Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be going through three key charts that an income options trader might consider when they're planning and placing an income option trade. And I noted pretty good discussion in our chat window out there on YouTube already, and a common theme has been selling cash secured puts. That's actually what we're going to be talking about today. Just coincidentally, but we're going to be maybe talking through three charts that a trader might consider first before planning and placing those trades. So a lot to cover. Before we get to all of that, though, let me first of all say hello to everybody who is out there in YouTube chat. Great to see so many familiar names as always. Hello there, Will and Lawrence, Greg and Kevin, Jay Richardson, Eva, Josh, Mark, on and on the list always goes. Thank you for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but be aware that you're invited to join us in the live stream discussion. If you'd like to be here, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Love to have you here as a live stream audience member. As a treat for my live stream audience members, my very good friend Barb Armstrong is going to be hanging out in the chats there. She's going to be keeping an eye on the questions that come in. If I can't get to them, Barb's going to be there to pick up my slack. Thanks for having my back there, Barb. But let's get into this discussion of having sort of a pre-flight checklist before a trader places that income strategy. What might be three charts they look to first? So as we do that, of course, the first thing that we need to do is consider the risks associated with trading and investing. This is important information, so bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views, and investing involves risks, including the loss of principal. All right, so you should also be aware that any investment decision you make in your self-directed account is solely your responsibility. And with that important information accomplished, let's set an agenda for today's discussion. First thing that we're going to do is look at our existing positions in our paper money portfolio. I think we have 6 right now, and I don't think there's anything necessarily that we might need to do with those today. Then we're going to have a quick look at what's going on with the markets, and we're going to look at 3 stocks as we're planning to add a new position to this income-oriented portfolio. Three important charts that we might check before we add a new position to this income-oriented portfolio. And then we're going to plan and place that trade. That's our plan for today. So let's go right to the Thinkorswim desktop. Here's our 6 current positions. We have on Apple a short put, sold 2 contracts of the 19th of December, 265 puts. The preference for the trader here, unless maybe they're initiating a wheel strategy or seeking ownership of shares, they're most likely just looking for these contracts hopefully to expire worthless. And that would be if the contracts are above 265 at that 19th of December expiration. Now, even then, somebody might get a wild hair and assign, but right now shares are at 276. Seems to be cooperating nicely. Here's what's going on with Apple. Entered those contracts here. The stock ran up, gave us some distance. We've pulled back. We're down pretty close to where we initiated the trade, but still well out of the money. There's the 265 level. We're up about $11 out of the money and working our way toward expiration. So I'm going to let that one continue to work. Sold those contracts for 277. Right now, it might be possible to exit for around 95 cents if the trader were looking to exit. But we're going to close this up. Let's have a look at our next one. We have Bank of America, where we bought 200 shares, and we've currently sold 2 calls at the $54 strike. So the preference here might be for the shares to go up in value, get as close as they can to $54, unless the trader's okay with selling those shares, and going above 54 might be just fine. But right now, shares are at 53.90. That's just about as good as could be expected at this point. So let's have a look at Bank of America. Here's our chart. We have some history with this position. We actually bought the 200 shares back here. We've already sold and collected profits on October contracts and November contracts Now we're working on December, and you can see how close we are. We've actually gone in the money a couple of times here. In a real account, even an out of the money contract can be assigned, but going in the money, especially as we get closer to expiration, can elevate that risk of early assignment. Early assignment just doesn't happen in these paper money accounts. But for this one, we're going to let that continue to work. That seems to be doing just fine. So going on to our Alphabet position, another covered call. Bought the shares a long time ago. This was the January trade. Right now, we're in a short call at 315. So we bought the shares around 199. If we're assigned on these short calls, that would be sort of a forced taking of about $115, $116 profit in addition to the premium collected. So we're not above 315 right now. Might be heading there. We'll see what's going on with Alphabet. Look at this. We've been above 315. Just today's price action has pushed this contract back out of the money, back down below 315. So we'll see. We have a plan in place here. Initially, we were going to exit if this support level broke, and it didn't. The new plan is if this support level breaks, and we're well above that, so we're going to leave that one alone. Microsoft, we have a short put here that we sold the 21st of January, 2028. So this one's stretching out 2 years from now, 774 days on those contracts. We collected $23 on these contracts. What we're hoping for here is for just maybe a temporary run to the upside sometime in the next couple of years. Hopefully, while the stock before the stock has gone too far down, we'd like a nice little run to the upside, bringing down the value of those puts, and maybe the trader might be able to close out at a lower price. That's what we're hoping for. It hasn't happened yet. In at 23, they're worth about 26. We're a little bit underwater on this trade. Most of our trades have done pretty well. I got to tell you, when I look at the S&P 500, managing an example portfolio of covered calls and short puts, every time it goes up, I think, oh, that portfolio is probably doing just fine. That's a teaser. That's a spoiler alert for the first chart in our 3 charts that we're going to be checking today. But with Microsoft, here's our trade. Just to give you a visual on that one, we entered our short put here, hoping to see prices climb. They did a little bit, and then they've kind of been waffling around since then. Our put is all the way down here. Our break-even point is down at 357, but we would like to see this climb. If we get back up to these highs, that would really move this out of the money and might give us an opportunity to get out at a much lower price than the $23 that we received. I'm going to let that one continue to work, though. NVIDIA is another covered call. Bought the shares at 183.71. They're worth 184.10, so just a little bit of a profit, unrealized gain on those shares. The call we sold for 3.5, it's worth about half of that. So with this, we'd like to be below 195 as we move toward that 19th of December expiration, but just below. We're actually at 184. So working our way, we'll see. Let's see what's going on with that chart. And NVIDIA, we have a little bit of history with this one as well. Not NVIDIA, NVIDIA, just NVIDIA. There we go. Get the right symbol in there. Bought the shares here. We initially got a nice sharp rally, and then we sagged back down, allowing these November calls to expire for a 340 profit. So that's a realized gain already. And then we've sold the December 195 calls for another 350 premium. So we've lowered our break even now to 176.81. We're above that, fading off of session highs right now, but overall moving in the right direction for the share ownership and still below our strike. So that one looks like it's doing just fine as well. And finally, we have our ExxonMobil position. This one just a little bit underwater, 40 bucks as of the recording of this session. Paid 116.81 for the shares. They're worth about $1 less than that, but we collected a 220 premium, and that's worth about 60 cents less than that. So that's leaving us with that $44 unrealized loss. We'd prefer here for ExxonMobil to move toward 120. It's not yet going there. We'll see if it's able to. With Exxon, here we sit, break even just below. let's have a plan for this one. If we break through this recent support level, we're going to talk about maybe exiting there, but we're still above that and some distance to go before our contract goes in the money. There's still also lots of time left on this contract all the way out here to the 16th of January. So that trade is doing okay. We'll just let that one work as well. So there we go. So those are our current 6 positions. I wanted to add to these. So we're going to be adding some more income to this portfolio because that's what this series is all about. But as we do that, I want to go through a little checklist of charts that an income-oriented options trader might look to as they're planning their income trade. And the first one, as I've already mentioned, might be checking on the stock indices. So I use the S&P 500 to stand in for just broad stock ownership in this discussion. Not everybody checks that as their primary index, but we're going to look at the SPX. And as I mentioned earlier, when we have a portfolio consisting of bullish income strategies, and that's what these are. Covered calls, short puts, net are both bullish positions. When the S&P or other indices are going up, that trader's probably feeling pretty good about the likelihood that they're doing pretty well in that portfolio. So on the other hand, if they're trading these same strategies at times when stocks are persistently bearish, they're probably not accomplishing a lot more than slowing the bleeding with that income. So let's go see what's going on with stocks right now. So here's the S&P 500. Not getting off to a great start for this week, but really off of these all-time highs on the S&P 500, how far have we fallen from those? I'm going to do a quick measurement using our trend line tool. If I go right up here to that peak and pull that right down to the current day, that is about 1% off those all-time highs. Now, that's not to say that markets can't just continue to sell and drag down the performance of short puts, drag down the performance of covered calls, but it hasn't happened really much in recent history going all the way back to April. And let's say that as our hypothetical trader, our income-oriented trader, is looking at this first key chart, maybe they see, all right, things have been going up, but they think there's maybe a price ceiling for a period of time. And I actually got comments along these lines in the chat window before I kicked off this webcast. So I thought that was interesting because that was sort of the premise that I'd already thought through for this discussion. Now, let's just say that we are an income-oriented trader who's still overall bullish on the markets, but maybe they think that we're more likely to pull down for a little while, possibly just going down to previous lows, somewhere in that range. So instead of loading up on stocks right now, maybe what they would prefer is just collect some income and try to get some stocks at lower prices. And that's actually a common approach to selling puts for income. That's what we're going to be doing today. But we're not yet ready to place our trade. What do you suppose? I've already told you, chart number 1 is looking at what's going on with just the stock market, using an index. Well, income strategies using options aren't reliant entirely on stock prices. Also, options prices play a role. So what might be a second chart that options something like the volatility index? Now, I'm going to come back, make some comments on this, but I first of all have to say, I just noted a survey has been added to the chat window here for the live stream attendees. I had a question in the comments. I was answering YouTube comments this morning, and somebody said, hey, how do I fill out the survey? Well, you come to the live stream. That's how you get that chance to fill out the survey. So if you are here, take advantage of that opportunity. Click that survey link right now. Just wait till after the webcast is over to actually fill it out when you can give me some honest feedback. But I'll just tell you a couple of quick things about that survey. It's super short, 2 multiple choice questions. There's a comments box and a suggestions box if you want to add some additional information there. But I just want to promise you, if you take the time to fill out that very short survey, I will definitely take the time to read it. It's always helpful. It doesn't just go off into the abyss. All right, so let's go have a look at this chart number 2. So going back to this, if you haven't used the VIX before, that's what we refer to it as, the VIX for obvious reasons. The chart symbol is VIX. What this is a chart of the anticipated volatility of the S&P 500 for the next 30 days, according to basically the options traders. Generally speaking, when options traders expect a lot of volatility, they'll pay more money for options as they're maybe trading calls or puts as speculators. Now, at the same time, if they're using options for the hedging of portfolios, of stock portfolios or other positions, that can also motivate them to spend a little bit more money, spend a little bit more liberally, because it might just, when they see high volatility, that might represent risk in the marketplace. But in any case, bottom line here for this chart is that when the VIX is low, that's generally seen as a reflection of lower options prices. When the VIX is high, that's generally seen as a reflection of higher options prices. Both of those closely tied to volatility, closely tied to risk. So where do we find ourselves right now? Well, I drew in a couple of lines here to give us an idea of where sort of normal levels have been for this year. This isn't always true, but with one exception right back here, the volatility chart has spiked up and topped out at around that 28 level. At the same time, the bottoms seem to be for this year around 14. So right now, our volatility is around 17. So it's only 3 points off the bottom. It seems to be quite some distance off of shorter term peaks. And so for traders here, what they may describe this as being sort of lower premium environments. And when premiums are lower, that can have some implications for options traders. Some people say this is a buyer's market. Okay, that might be true. If a trader's looking to buy options, this may be a window of time when options are less expensive than they are at other times when volatility levels are higher. But that would almost seem to imply that the trader can't sell options. If it's not a seller's market, doesn't that imply that we shouldn't sell? Not necessarily. Here's the way that an income investor or an income trader might see this. They might just have to prepare themselves emotionally for a couple of things. Number one, the premiums probably aren't going to be as high. They might not be as good as they have been at other times over the last 12 months. Now, there's a reason for that. It's because the markets are less choppy. That might mean that there's less risk. Why would we expect to get compensation for high risk market conditions when they don't appear to exist? That's the reason for the lower premiums. Now, another thing that they might be prepared for is that if volatility starts to rise again, that can slow down the income earned on a per day basis and on an unrealized gain basis in the form of time decay. All right? Yep, rising volatility can effectively slow the passage of time. Not really. It's actually just an offset of, it's sort of a vega versus theta battle. But if you didn't follow that logic, just know right now, for a lot of stocks out there, the premiums just aren't as high. The reason is options traders don't see it as risky a market. That's it. Okay. So that's chart number 2. Look at what's going on with the stock market is chart number 1, SPX being an example. Checking to see what's going on with the options market is chart number 2. And then chart number 3 is just the chart of the stock that we intend to pursue the income through. So how do we select a stock? If we're going to do income strategies, covered calls and short puts and that sort of a thing. Well, it could be for any number of reasons. It might be because that stock is in a sector that a trader thinks is going to be doing well. And these strategies that we discuss in this webcast series are bullish. So that could be a key key element of the trader's decision there. It could be that the stock is the right price for them if they wind up buying the shares or getting assigned through a put. Might be affordable for their portfolio. They might also be attracted to a stock because it has lots of liquidity and the options tend to be more favorably priced as a result. In other words, the spread between the bid price and the ask price tends to be narrower when a stock is more liquid and its options are more liquid. But a final consideration is just what's happening with the chart. So I'm going to use as our example trade today, Amazon. Amazon, great big huge company, one of the biggest companies out there. So one of the most liquid companies out there for the purposes of trading. whether we're talking about stocks or for options. It's also a stock that's not really on the high end of those triple digits, $227. I'm not saying that it's going to be affordable for every portfolio, but if we're about to enter into a contract where we're agreeing that someone else can sell shares to us, 100 shares, we're taking on ourselves about a $22,700 obligation. That may fit within some portfolios. But also look what's happening at the chart. Let's see what's going on with the chart here. Amazon has been kind of bouncing back and forth for the last 6 months or so. Maybe going up toward the high end of that in recent weeks. Yes, it did get a little bit higher for about 2 weeks here. But other than that time frame, we've just been trading in this range for Amazon. So let's say that our trader looking for income and maybe for share ownership would be okay. Let's collect some income first and maybe position ourselves that if those shares get assigned, we're assigned down here closer to the price floor. So here's what I'm talking about. Looks like the price floor over the last 6 or 7, so I'll call it 6 months. Over the last, is it even 6 months? I don't want to be overstating things. 1, 2, 3, 4, 5. It's more like 5. Okay. But let's say that our trader would be okay with the addition of Amazon to their portfolio, the assignment of shares, if they didn't have to pay these relatively higher prices. Maybe if they were able to buy the shares down here closer to spot, which appears to be around 215. So we're using the stock chart within the context of what's happening with stocks in general and with what's happening with options in general to position the trader for entry into the shares at their preferred levels, maybe. Here's what we're going to do. We're going to get into a contract where we agree someone else can sell us the shares for $215 in this case. I want to go see what's available. Now, if you haven't ever done a short put, I'll talk you through what this means. But let's go to the trade tab. Let's load up Amazon. And I'm going to go out to the 16th of January. Let's say that our trader is okay with obligating themselves at any time for now, between now and the 16th of January, to someone else being able to sell them shares at $215. That's what we're going to be doing today. We're actually doing this in a margin account. So when I said earlier that someone was talking about cash secured puts in the chats, this one is actually a margined position. It's not cash secured. That affects just how much cash is being essentially tied up in the trade when we're margining this. But let's go, let me just load this back to our covered calls and short puts portfolio. Anyway, but here is the deal that we're going to be getting ourselves into. We bring up Amazon in the trade tab. Down here is our option chain. This is just a sort of an advertising board of different contracts that we can get into, ranging from a period of anywhere from 4 days all the way out to 921 days. And for our income trader, they might think, ooh, maybe I'll just get into something for just 4 days. Well, I'm guessing there's not going to be a lot paid. Let's see, 215 put. Yeah, it looks like about 28 or 29 cents that someone might be willing to pay for the right to sell us shares at any time between now and the 12th of December. In other words, the end of the week. It's just not very likely that stock is going to go down that low. All right, okay, Eva says it doesn't matter to you. You don't even use your margin in any of your accounts. Yeah, just in this, I just wanted to make that distinction. This one is being placed in a margin account. So it does, for this account, makes a little difference, a lot of difference. Anyway, let's say that 28 cents isn't quite going to cut it for our trader here. Maybe they go out to, I'm just going to exaggerate things. What if we went and entered into a contract for the 16th of June of 2028? 921 days from now. Well, if we get into a contract and agree, oh, we don't even have 200 or 215, even 210, somebody might pay us $33, $34 per share for that right. But then the trader could be on the hook for a while. 921 days at the longest. Ooh, okay, so let's let's say that we're looking for some balance between getting enough premium to make the trade worthwhile and maybe not being on the hook for an extended period of time. Although there's nothing inherently wrong with that approach, because we even have a position where we've done exactly that, as we discussed earlier. But let's just say that we go out 39 days. I'm going to go to that, see what's being offered at this moment for the 215 put. Looks like it's 365 to 375. Let's call it $3.70 per share. So this is going to be our example trade for today. We're going to sell a short put. And specifically the 16th of January, 215 put. And that looks like that's trading still about 370. It looks like it slipped a little bit, 360. Maybe the stock went up a little bit, made the puts a little bit less valuable. Let's call it 365. That look like that's going to be, yeah, that's kind of a realistic number to use at the moment until we see what we can actually get this filled for. But in any case, for the benefit of those who are not familiar with selling puts, here's exactly what's going on. Conceptually, what we're doing here, putting ourselves in the shoes of an income investor or an income trader, we would be accepting a payment of $3.65 on the potential exchange of 100 shares of stock. So it's $3.65 per share. That would be $365 that we're getting paid. Ooh, great. Well, that's the pro. That's the potential advantage in this trade, $365 of possible income. The potential con here, the possible disadvantage, depending on how one looks at this, is that for the next 39 days or through the 16th of January, someone has the right to put shares into our account. In other words, force a sale of shares through this contractual obligation of ours. They have the right to sell shares to us for $215 per share. And you might look at that and say, Cameron, the shares are worth $227. Why would they do that? Well, they're worth $227 right now, but they can do this at any time in the next 39 days. And if those shares drop in value, they may decide, ooh, the best person to sell to right now is Cameron or our hypothetical trader there. That's the deal. So what's the advantage? $365 of possible income. What's the con here? We might have to buy the shares. So the trader needs to go into this with eyes wide open. We might wind up with the shares, and at the moment we wind up with those, we might not be thrilled with having to pay $215 according to the terms of the contract, because the shares might not be worth that much at that moment, that future moment. So let's have a plan in place. At what point might the trader decide, I don't want to be in this deal anymore? Well, if the shares are falling and falling hard, that might change their mind about putting themselves on the hook at 215. Yeah, oh yeah, retail investor says we might get paid to buy the dip. That's the ultimate objective here for some traders. Yeah, because let's just paint like the happiest picture we can. Let's say that the stock goes down as we're moving toward that 16th of January expiration, and we get right down to 215, and maybe we go a penny below it. See, I'm telling you the happiest scenario where I can. So there we go. Stock goes right down to support. Let's say it's at 214.99, and we hit expiration. What is almost certainly going to happen at that point? If the stock is below 215 at expiration, well, someone has the right to sell us shares for 215. If that contract has gone in the money, even by a penny, and we hit expiration, in the money contracts are assigned at expiration, unless there's explicit instructions left by the owner, that's the other party, to not do that, and that's not very common. So yeah, so oh no, we get stuck with the shares at 215. They're worth 214.99. Okay, so we have a penny unrealized loss at that point. But we'd also have the 365 that was paid up front. That's not a bad outcome. We own the shares at support. We got paid for the privilege. This is wonderful. that is very contingent on, first of all, that being the scenario that we happen to be right at support, and also that the stock doesn't just continue to fall as we are now the owners of those shares. So yeah, this trade could go wrong. Now, another way that it could go wrong is if it doesn't happen to play ball exactly, and instead, let's say that it's falling a little harder. Let's say that instead of just coming down to support, it breaks down through support. Now, we might have to buy the shares for $2.15 and they're worth substantially less than that. Might not even be worth the income that was collected up front. So let's just draw a line in the sand for the future management of this trade. Let's have a plan from this day all the way through the end of January 16th. I'm going to draw a line right here at, let's say, 210. That's below that support. There isn't even a single circumstance in the last 5 months. See this? We got below 215, but never down to 210. We got below 215 on about 4 occasions right there, never down to 210. Let's just say for this trade, we're going to consider, not consider, consider exiting if support breaks. This should be terminology that looks pretty familiar. Common approach that we use in this webcast series. There we go. We're going to consider exiting if support breaks right there. I'm just going to edit the properties of this. And we're just sort of defining a support break as, let's say, getting all the way down to 210 into brand new sort of bearish territory that we haven't seen in 5 months. Other than that, we're going to let this thing play out. So if we do, let me ask you, what's the most likely outcome for this contract that we've entered into, this income that's been collected? Now we're just trying to see if we get to realize that income. What's the most likely outcome for this trade? Most likely outcome is we just realize this gain and we don't wind up with share ownership. Come January 16th, maybe we just move on and go look for another income. Because look at where the stock is right now. If the stock goes up, if the stock goes sideways, or if the stock goes down but doesn't go down below 215, the most likely outcome there is the shares are worth more than 215. Someone has the right to sell those shares to us for less than those prices. There's not much motivation to do that. Unless they're just a really generous individual by nature, there's little motivation for them to assign the right to sell shares to us for 215 if they can sell those shares anywhere else in the market for a higher price. So yeah, if we're above 215, that most likely outcome is the contract just expires worthless, unassigned. We keep the 365 and move on to the next income trade in this series. If the stock goes down below 215, that's when the trader, the other party in this transaction, has particularly pointed motivation to sell those shares to us, because they can't get 215 just in the open marketplace from someone else. They can only really get it through the terms of this contract. So they assign the contract and they sell the shares to us for 215. Now, before I go place this trade, I got to say, if the contract gets assigned, does the other party get their $3.65 back? This is a common misconception, or it's a myth. Yeah. It's commonly misunderstood that if a contract gets assigned, that means we've got to give up our 365. No, we don't. Nope. We do have to pay 215 for those shares. That would be true. But if on assignment, the 365 becomes a realized off the hook, not off the hook, but realized gain on the an option. That's it. Okay? And then we just see what happens with the shares after that. Now, if we get assigned, but we're still above support, let's just have a secondary plan that we will then sell calls against those new shares. Let's see. iShanes says lots of consolidation occurring. You're talking about the Amazon particularly? Is consolidation necessarily a bad thing for this trade? Nope. if we consolidation sort of means just kind of going sideways. That's sort of chartist or trader speak for kind of going sideways. Going sideways would just be, in this trade, the ultimate realization, unless something weird happened, of our 365 income. So let's go place our trade. I'm going to go to our 215, 16th of January contract. Looks like that's gone up a little bit, but it looks more like we'll be able to get 370 again rather than the 365. But let's see. I'm going to click on the bid price. And this is where the trader would pause to figure out, well, do I want to get into 10 contracts and obligate myself to maybe have to buy 1,000 shares of stock? Do I do one contract and obligate myself to maybe have to buy 100 shares? Well, at 215, in this webcast, we typically don't mind tying up about $5,000 in a trade. Let's do 2 contracts here. Let's go up for sell 2 of these contracts. That would be obligating us maybe to have to buy 200 shares at 215. Looks like 370, we might be able to get that. I'm going to back off to the 365. Let's see, Ted Barron says, if the put is exercised at the 365 a realized gain, it is. Yes. So on the option side of the equation, we have a realized gain. But we also now have ownership of shares at 215, and whether that's an unrealized gain or loss just depends on where the stock price is. I will say, most likely, it's been assigned because the shares are worth less than 215, so most likely at the moment of assignment, we have a realized gain on the option, but an unrealized loss on the stock. And Ted says, doesn't it become a reduction in the basis of the shares purchased? You're talking about the tax implications of investing. There are actually 2 trades going on here, stocks and options. Talk with a tax preparer about how to deal with that, okay? I'm always tempted to give the answer. I don't comment on the tax implication of trading because it's outside the role of my, it's outside my role as an educator. Yeah, talk with a licensed tax professional or with a financial advisor. Okay. Let's put in our trade. Let's click on confirm and send. Let's see if we can still sell these 2 contracts for a limit of $3.65 per share, selling the 16th of January 215 puts. That would give us a credit of at least $730 minus the commissions to be paid here, $1.30 in commissions to be paid. And we'd then have that obligation to maybe have to buy 200 shares. Now, notice in a cash account, this would tie up about $42,270 in anticipation of the potential assignment of those shares. We'd, $215 per share times 200 shares, $43,000 minus the credit received leaves us with $42,270. In a margin account, it ties up less cash, well, for better or for worse. So it doesn't tie up as much cash, but if a trader goes and places a whole bunch of similar trades, they expose themselves to more risk and more reward. So there are pros and cons. Anyway, but that's going to be our trade. And let's send this order off and see if we can get it filled. 365 to 375. Yep, we're asking 365, and we actually did fill at 370. That's exactly what we've been talking about through most of this discussion. So we got it done, and we did this using information from the stock market, the options market, and from the individual stock itself. Even having checked that list of 3 key charts, it's not a guarantee that this trade is going to work out. So we have a plan now. We're going to let this ride, hopefully just to see this expire worthless come January 16th. But if the stock happens to fall down below 210, below this support level, we'll look to buy the contract back. If it's assigned at that point, we'll decide what to do with the shares, probably sell calls. But guys, this is what we do on Mondays. I hope you enjoy this discussion. Trading covered calls and short puts is the theme on an ongoing basis. So if income is a point of emphasis for you and you're trying to add polish, maybe come and join me or check out the recordings for these webcasts. That brings me to a point that I want to make. If you're not able to view these live streams, that's okay. Check out the recordings. But whether you're viewing live or you're watching the recording, make sure you subscribe to our Trader Talks channel. Great resource is to subscribe here. So you can just go down below the video right now, click on the subscribe button. But our Trader Talks channel on YouTube is where you can join live streams. You can watch the archives right here. You can find a full list of webcasts from the vast majority of our webcast series. So I'm going to click on playlists and I'm going to scroll on down. This webcast series is toward the bottom. It's kind of the middle right there, trading covered calls and short puts. If I click on view full playlist, you can see last week's discussion. We talked about 5 things to watch for in 2026 when doing covered calls. So I think that'd be a great webcast check out if you want to go look at that. Another suggestion that I have for you is that you follow your favorite Schwab presenters on social media. So you can find Barb and me on X, on that platform. Barb is very active there. I'm very active on X. And when you reply to one of my posts, I try to reply right back to you. But you can follow Barb on X at Barb Armstrong CS. You can follow me on X at Cameron May CS. So it's a great place to interact with your favorite presenters in between the live streams. Another place that you can follow me is on LinkedIn. So this is pretty new, just within the last month or so. Go to LinkedIn. So it's linkedin.com/in. That's sort of the generic prefix for the URL here. But then just throw on a /Cameron May CS, and that'll take you right to my profile, and give me a follow. And if you reply to me here, I reply to you right back again. And again, I like to throw out this, unless you say something inflammatory or you're talking about some topic that's just off limits. I don't reply to everything, but the vast majority. Nice thing about LinkedIn is I can go into greater detail. I don't have that character limit here. So that's nice. But that's going to do it for your Schwab resources. Final suggestion that I have, two things. Thank you to everybody that's already clicked the like button. That definitely helps as a pat on the back to your presenter. It also gives us a boost in the YouTube algorithm whenever you do that. So yeah, if you enjoy one of our webcasts, click the like button, the thumbs up. But yeah, the final request that I have of you is that you fill out that survey. So Barb has very nicely reposted that survey link a few times in the chat window for the live attendees. So click on that survey link, fill that out. I will read through the data. I read through those survey comments, and it always helps. All right. Everybody, thank you. I will look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.